So, what is the SALT deduction? Well, I think it's important to rewind to the Tax Cut and Job Act that was passed in 2016, which came into law in 2017, which prior to that coming into place, if you lived in a state that had a state income tax or your property taxes, even if you lived in a state like Tennessee, Texas, Florida, where there is no state income tax, you could deduct your property taxes, any state or local taxes, that's what SALT stands for, state and local taxes, against your income for federal tax purposes. And so the SALT deduction limit was put in place back in 2017 under the Tax Cuts and Job Acts, which basically limited individuals to a cap of $10,000 per year that they could use as a deduction against their federal income tax for state and local taxes. Okay, this was not received well by citizens of states like California, New York, Illinois, New Jersey, that were in states that have fairly high state income taxes because their tax bill went up big time. And so there was a lot of people that were not happy with it and maybe even decided to move because it became that much more expensive to live in that state. So under the One Big Beautiful Bill, this was modified from $10,000 per year to $40,000 per year. So a lot of clients that are in states that have high state income taxes, or even they live in a state with no state income taxes, but their property taxes are high because they live in an expensive home, can now take greater deductions for this. However, this is not permanent. And so this increase in the SALT deduction is only good until 2029. And there is an income phase out. And so I'm going to reference this chart to talk through here how this works. So we know in 2024, the limit was $10,000. In 2025, that has been increased to $40,000. It stays at that limit with a 1% increase every single year until 2029, where if nothing changes in 2030, it will revert back to the 2024 limit at $10,000. However, this also has some things to be mindful of with your adjusted gross income because there are some phase outs to be mindful of. This is not for everybody, okay? This is really for the middle class and families of America that earn less than $600,000 per year. The phase out actually begins at $500,000 per year. So if you're in that range where your adjusted gross income is $500,000 to $600,000, we'll walk you through an example of how that could work. You don't forego that, but there is a phase out that I'll walk everybody through. But if you're under $500,000, congratulations, you'll take advantage of the full $40,000 SALT deduction. So I'm going to reference two different families here. First, we're going to start off with the Martinez family. They live in the state of California. They earn annual income of $420,000 based on California state income tax and their property tax. We're going to make the assumption that they pay roughly $28,000 in state and local taxes. And because their adjusted gross income is under $500,000, underneath the old tax law where they were limited to a $10,000 deduction for state and local taxes, now under the new law, they're able to take a deduction for all $28,000. And so this is going to increase their total tax savings under this new provision of the One Big Beautiful Bill to $4,300 in tax savings. So wonderful for the Martinez family. Let's use another example here with the Chen family, who also lives in California, who is in that phase out. They're earning $570,000 per year. So their state and local taxes are $38,000 per year. So they're over the $500,000 threshold phase out, but they're under the $600,000. And so under the old law, again, they would have the opportunity to deduct up to $10,000 of those state and local taxes. But under the new law, they're able to take $19,000. And so there's a reduced deduction due to the income phase out. Basically, there's $70,000 over the threshold. The multiplier of that will use 30%. So it's a $21,000 reduction in that. So effectively, the way the math works is that they're able to take $19,000 of total deduction under the new provisions under the One Big Beautiful Bill and still net a tax savings of $2,200 per year from the increase in the state and local taxes under the One Big Beautiful Bill. But this is an example of how the phase out works if you're between the $500,000 and $600,000 threshold. So for those watching this, there's a lot of opportunity here, and I think there's going to be a lot of clients that can take advantage of this. One of the ways that we see this playing out with clients and their CPA, for those that are business owners or who can control their income or potentially take deferred income through things like deferred compensation plans and things of that nature, I think will open up the opportunity for how they can potentially defer income or take deductions to offset some of that income to take advantage of this. But I think this is a wonderful opportunity for those that are in and around that threshold where there may be some creative ways to take advantage of certain provisions that can help reduce that income where they might qualify for the full amount there.